Hello, everyone, and welcome. There is no slam dunk in investing. My featured guest today needs no introduction in the investment world. We are pleased to welcome legendary investor Stephen Romick, founder and co-head of the five-star and gold-rated FPA Crescent Fund, where he oversees $10 billion in assets. FPA has been an important partner for Staub Financial and our clients over the years with the goal of achieving equity-like returns with less than market risk. It's done just that and more, considering that it's produced almost the same performance of the S&P with roughly half the risk. FPA celebrated its 30th year in 2023, making Stephen one of the longest tenured portfolio managers in the industry. In 2013, he was named Morningstar Allocation Manager of the Year and was nominated for Manager of the Decade from 2000 to 2010 during both the tech bubble and the global financial crisis. He was recently honored with writing an intro into the latest edition of Security Analysis, the timeless investment classic, who many view as the Bible of investing and stock picking. Today, we discuss his evolution as a value investor, margin of safety, important characteristics of great investors, and why there is no slam dunk in investing. Stephen, welcome.
Thank you very much for having me, Corey.
You recently wrote an intro to the Chapter 7 edition of Security Analysis. Many view that as the Bible of value investing made famous by Graham and Dodd. And obviously, you discussed recently your evolution as a value investor. Can you touch on that and what makes Crescent different than most funds?
You know, security analysis, is a Bible of has been the Bible of value investing. But what I think Seth Klarman tried to do was make it a little bit more constitutional in its organicness and have amendments added to make it current, for the times. And I think back when the book was first written, the idea was in value investing is about protecting capital, and as Seth Klarman titled his book "Margin of Safety," a phrase that's oft used, just about people who don't like to lose money, people who want to make sure they're making an investment, and recognizing that things aren't always going to go exactly as planned. So how can we go and preserve the downside and yet not forget about the upside? And back when security analysis was written, it was heavily weighted towards this idea that the margin of safety really was predicated on the balance sheet as protection. You were buying a business below book value, maybe below net working capital. Maybe there were hidden assets, on that balance sheet or off balance sheet, as the case may be, in the form of land that's been unmonetized, et cetera. And over time, that worked well for a lot of years. But I think that certain investors, were ahead of the curve, like Charlie Munger, who really pointed out to Mr. Buffett that Warren, maybe we should think about the quality of this business, is not just looking for cigar butts with a couple of puffs left, and that directed them more towards things like See's Candy. And these businesses that can grow and throw, if you will, grow, earnings and throw cash flow for a lot of years. And, I was a little slow in the uptake. And even though I came up in the business well after they had bought See's Candy, I was a little slow and still focused heavily on the balance sheet looking for protection. But I came to realize after the turn of the century that many, these businesses were likely to be disintermediated by new paths to market, new technologies. And I realized that I just don't want to hang my hat on a business's balance sheet if that business isn't going to be as good a business, 5-10 years from now. So that kept us away from, certain things, certain businesses like Sears, which we did consider, and we don't debt of at a point in time. But why wasn't Sears successful, and Walmart and Target have done fairly well in spite of the inroads made into retail from online companies largely led by Amazon. And so understanding this and trying to work through, what businesses are likely to do well 5 and 10 years from now is a constant, theme as we look at our portfolio. So going back to security analysis, where that support was more driven by the balance sheet, it's now more by the quality of the business itself, which creates some additional volatility, in the portfolio, because identifying what an asset might be worth, whether it be a, piece of real estate in the books is not, likely to have as much variability, than as compared to, looking at what a business's cash flows, might be over the next 5 years and how somebody might value that 5 years, from now.
You mentioned volatility, which is a great pivot here. Can you explain to the listener that risk and volatility are not the same, and how volatility ultimately creates opportunity?
I think that is my point of view. However, I want to, push back on the framing of the question, because I think for a lot of people, risk is volatility. For me, it's not. So for me, volatility creates opportunity. Just because if something's down a lot, people are fearful, that gives us a chance to lean in and buy a company or invest in an industry. If stocks are up a lot, or a company's up a lot because people are very excited about its prospects, that gives us a chance to sell to that excited investor at a price hopefully much higher than what we paid. But the reason why I'm pushing back a little bit is it's easy for one to say that, but
Yes.
can one live that? Can one really
Right.
separate themselves from what's happened in the market and operate in a disconnected way, dispassionately looking at price movements as nothing more than blips on a Bloomberg screen? Or will that volatility precipitate an action in the inverse of what should actually be done? So, for example, a lot of people, get that sense of FOMO, that fear of missing out, and their stocks are moving up, and they want to be part of it. So they get sucked into the internet bubble. They get sucked into some other tech bubble, or believe in crypto more than they should, or they believe in crypto because it's going up, not because they really understand, that Bitcoin, should be, is valued at, is at a certain dollar, dollar value. Is Bitcoin worth 5,000, 20,000, 50,000, and why? Rather than doing that, they're just focusing on the fact that stocks are going up and Bitcoin's going up. And similarly, do they have the knowledge and understanding of the business in which they've invested to have the comfort that when things aren't going as well for that stock at a moment in time, that they've got the staying power to stick with it, not panic out? And for those people that don't have that ability, volatility is an accurate measure of risk. And I think that volatility is an accurate measure of risk for most investors, only because that's what we've seen happen in the market. Morningstar's has some very good data that shows the more volatile funds have a greater spread between what the investor return and the fund return is. So the investor return, the fund can return a certain percentage over a decade, but the average investor might have a return that's vastly different than that because they bought and sold at exactly the wrong moment. So by way of example, there was a fund, and I'm trying to do this from memory. There was a fund in the OOs, the best performing fund in the decade was, I think it was Ken Heebner's CGM Focus Fund. And that fund compounded 18% or so. And if I'm remembering this correctly, the average investor's return was less than that. Not just less than that, it was negative, not just negative.
Negative. Yeah.
Solidly negative, like minus 14%. So more than 30 points behind what the fund did. This is no fault of the manager at all. He never, telegraphed, any kind of anything other than what he was actually doing. He did very, very, very well. And those people that understood what he did and had the commitment to him as a manager, performed exceptionally well over the decade. Those people that didn't have that commitment and that conviction in understanding what their manager was doing for them in this portfolio, bought and sold the wrong times. He's killing it in the market. People bought in. He starts going down. It was a volatile fund. It was a very volatile fund, and people start panicking and selling at exactly the wrong time.
Yeah, and we see that historically. I mean, most of our core position increased their equity exposure during the pandemic, for example, you as well, which wasn't surprising to me, but maybe to some listeners. Can you explain and expand on your cash levels and the importance of it through these different market cycles where you've been very, very successful?
Cash for us is merely a byproduct of our investment process. If
Right.
we see investments, debt or equity, largely equity, that are offer attractive risk rewards, good companies purchased at good prices, then we'll buy them. These businesses, FD business, we expect to have a good IRR over the next 5+ years. And we have a host of reasons and a lot of work to support the rationale we have. No guarantee of an outcome. But if we don't find those types of opportunities, then we end up with more in cash. We end up selling into the strength, and if we don't have places to recycle it in securities, then it ends up in cash. And then when there are opportunities, we put that cash to work. So if you look at the financial crisis, we had, in 2008, we had mid-single digits or so in high yield bonds and distressed. And then, by, late in the first quarter, early the second quarter of 2009, we had more than 30 points in corporate credit. So that came down from, we pulled our cash down to really take advantage of what was a seminal opportunity in debt.
Speaking of debt, non-stock investments, as you're mentioning, have been an important investment for you in the past, but it hasn't been relative lately because rates have been so extraordinarily low, seemingly forever now. Are you finding any value there with rates increasing in the last, 12 months, 18 months?
Yeah, there are three factors that have kept us from investing in credit the same way we had historically, and not in any particular order. Factor one, as you referenced, is low rates. Factor two was the very, very narrow spread to that reference rate. And factor three is that in this low rate environment, a second order effect had been that the borrowers were getting a better deal historically than at time before. Not just the low rates, but able to control outcomes with very, very poor covenants. Poor covenants, weak covenants, from the lender's perspective. So in a bankruptcy, when you want to go and get the keys to the kingdom, you had a problem, getting across the moat. The drawbridge was up. Yeah. And so for those three reasons, we've not been that interested. So two things have changed. One, to your point, rates are higher. Spreads have widened out, somewhat. They're far from peaks, but they're certainly wider and not unattractive in terms of a total yield basis. However, the covenants are still pretty weak, and we worry about an economic downturn and restructurings and who's going to win. And too often the equity sponsor, corporate, the corporate owners are going to win more than the debt holders. And so that's kept us out. We have found opportunities in certain convertible bonds that have gotten busted, where people were don't have that same, where the average bond investor is looking more for current cash flow and is less willing to underwrite, the type of business that it is. It's a business that they may have never underwritten, heretofore. And so it's really something very, very new to them. And so for us, in these bonds of some of these corporate converts have traded down, to levels that offered us a bond, a very, equity-like rate of return with a bond, and it's not a secured piece of paper; it's a convertible bond. But we're very comfortable with the kind of the asset coverage of the business to that corporate credit.
You've been obviously very bottom up during your career, but you've had some excellent top-down views that are in your newsletters, but something that you don't necessarily brag about. You shared your concern of easing monetary and fiscal policy, debt, inflation, like a lot of people. But where are your largest concerns today, and how does that affect the current allocation in the portfolio?
That's a very generous interpretation, and thank you for that. And looking and as a longtime reader of our shareholder letters, because the truth is, there's far more things that could happen than will happen. And we're identifying those things that could happen. We're not handicapping the likelihood of them happening. And so we try and protect our portfolio and have it be robust to multiple outcomes. We felt that rates would go up long before they did. We thought inflation would peak its head, would peek its head through the blinds, far before it did. And so had we actually invested predicated, on that, we would have been a pretty tough call. Now, when rates were so low for so long, the idea that they might go up, became, something that, seemed like an impossibility to a lot of people. And so we were able to purchase derivatives at very low premiums in them, that were able to pay off well in the event that rates did go up, which they did. So we made a little bit of money last year because of that. Not, by the way, it was binary. We had no idea it was going to happen. We had no idea how much rates would go up or if they would go up then. But, it was a very inexpensive, option. It was binary, but it had terrific asymmetry in its returns. We could make a lot of money and put a very small portion of the portfolio at risk. And we've done that at points in time in the past. But we the fears today, getting to that question, is of course, certainly, there's two big fears that I have. One is we haven't had a real recession in a long, long, long time. It really goes back to the financial crisis. Yeah, we had a recession, because of COVID, but the government stepped up so quickly and put capital, flooded the system with capital that it, created a lot of opportunity for people to continue to buy goods and services. And so we didn't really see the economic downturn that might otherwise have occurred. Now, I don't want to go on record saying the government should have done this or should have done that, because, I'm not good enough to opine, candidly. But we're very good at responding, to what's out there. And so we do think there's going to be at some point a downturn, and some of these companies that haven't seen a downturn in quite some time are going to have troubles as a result. And we also do worry about, or should say I worry, I don't want to speak for my partners, I worry about the massive amounts of debt that exist out there in on a sovereign basis. And I think the only real way out of that is to inflate, pay back that debt in with less valuable dollars in the future.
Well, where are you finding some opportunity today, perhaps globally? And you talked recently about upping the quality of the business in this environment.
And that goes back to the early part of our conversation when I talked about the issues as it surrounds our evolution as value managers, not the issues, but just our evolution as value managers, migrating from the balance sheet to the business. And if you're going to do that, you want to be more confident in the quality of that business, and their management teams to execute, on a strategy from, for the company. We try and broadly look at, when we're in equities, the equity side of our book, which is the biggest part of our book, we generally, we have two big components. We want to understand the better businesses in the world, which are not evergreen. I mean, some businesses might not stand the test of time, but so it's a list that moves around. But it's we're constantly replenishing and understanding these businesses around the world. And then there's the more commercial opportunities, those businesses that are maybe not as good a business, but they're really, really hated, for a moment in time. And so it can create a good path in and create an attractive risk reward for us. And so that, leads us to, as we see opportunities around the world, today, leads us to, if you think about where there's bad news, we're going to be looking, considering, commercial real estate. People hate it. Remote work. As people work from home, you need less office space. So goes the bear argument. And certainly to an extent that's true. But there's A buildings, B buildings, and C buildings, and there's good markets and there's bad markets. So if you can find commercial properties in the better markets with the A properties with better management teams who have a good alignment of incentives, with you, they're the large shareholders, then it could be an interesting place to shop, particularly or hunt, if those businesses are not overly encumbered. They have some flexibility to get them through to the other side, not knowing when there might be a rebound. As we can't put a timeline, a tight timeline on that, but we have to make sense of what might transpire in the future. And we think that these big businesses with good management teams have a lot of flexibility. They should be pretty attractive investments. So we own a couple commercial real estate investment trusts, and we also have identified some single asset mortgage-backed securities that we don't own that we might buy if those prices get there. We they're on our shopping list, and the price may not get there.
I remember listening to a podcast a couple years ago, and I really don't remember who it was with, but you were on there, and you've talked about disruptive technology and how this has changed your investment rationale. It was a beautiful, it was a really, really thought-provoking statement that you made that kind of ties into your evolution. Can you touch on that a little bit?
Yeah, this goes back to at the earlier in our conversation, I was talking about the kind of companies that can disintermediate another company, and I used Amazon as an example, and as part of one of the businesses that have hurt other retailers, and we sold our retailers in part to a great degree because of the online competition was coming through, as we didn't understand who the winners were going to be in the old brick and mortar business and how they were going to compete, and so we took a seat on the sidelines and watched what was unfolding, and I mean the biggest mistake we made was really an error of omission, which was not having bought Amazon. That was Mark, Brian, and I read the Everything Store after it came out, and we're like, wow, we really should have we'd done better work on Amazon, deeper work on Amazon back certainly in the financial crisis, when they'd already been around for a long time, at that point, decade or so. And so those we avoided retail, and we've a lot of times your returns are driven not just by what you own but what you don't own, and so that was added to some of our successes, but it also forces us to ask the question: how might it get disrupted? What could happen? Who benefits from AI? Who gets hurt by AI? These are the kinds of questions that we're constantly asking ourselves.
Well, you just touched on probably perhaps your greatest achievement is staying away from the overpriced and the overloved and the hyped over the years, and which is really what helped the return so much over the last 30 years. Can you talk a little bit more about standing on your own? And you talked about the willingness to be unloved almost.
Yeah.
And how that has been so important over the years.
We really think about our performance over full market cycles.
Yes.
And by thinking about that and having that longer horizon, it allows us to keep our eye on the ball. And you take your eye off the ball if you start worrying about what's going to happen this quarter or even this year in performance. So if we invest for the future, then we think we're going to do better, at certain points in time along the way, that's going to allow for good returns over a market cycle. And it's really not any different than some of the better corporate managers do for the businesses in which we invest. Or using that Amazon example, businesses in which we didn't invest. Bezos looking where he wanted the business to be down the road and investing his cash flow for that at the expense of current earnings. And so standing on our own can be a little bit lonely, admittedly. I mean, when people are saying, why don't you own crypto? Or why don't you own at the turn of the century Microsoft? It's so easy to own Microsoft. Well, we waited, another 10 years or so to buy Microsoft. And, Microsoft throughout the decade in the aughts, earnings grew in the high teens and the stock was flat to down. So They grew into their earnings and the stock became very cheap and we ended up buying it. but people look at us like we're crazy for periods of time, and that's okay. Like we look crazy to some people when we didn't own any. I started out as a bank and thrift analyst working for an investment partnership. I was a generalist, but that was a significant area of focus. And I owned a lot of financials for a lot of years. And then I saw what was happening at the turn of the century and early in the aughts, and I saw the rising credit default swaps and then the off-balance sheet leverage that so many of these big banks and other financial institutions like the investment banks had, and I saw the rise in easy money and to residential mortgages, and I saw the higher leverage on balance sheet, on at the banks. And there's this old accounting line, that the left side didn't look right and the right side didn't have much left. And that was true of the banks, where there was just not enough equity to support, what weren't good assets. And so we stayed away from the banks entirely, and it didn't look so good, when they were performing well. And so we have a lot of active share, in our portfolio. We don't worry about what we look like over short periods of time.
So, my journey to understanding investing over the years, whether it was, Buffett, Munger, Eviard, Marx, I ended up learning, in my journey to try to figure this out, I ended up learning a lot about life. And I'm convinced that great investors like yourself exhibit certain traits. And one of those traits is understanding people. And I'd say another one's probably understanding history. What are some other great traits that you feel are not discussed enough in terms of being a really good investor?
I think, psychological traits like, being able to look at yourself with a certain amount of introspection and humility, where you understand your strengths as well as your weaknesses, and work on improving those weaknesses and surrounding your people who are can buttress those weaknesses, and not taking inappropriate action if you don't really understand, that you are, acting on your weaknesses as opposed to your strengths. So having that humility that you're not always right and things aren't black and white. We operate with a grayscale. That's also important. Knowing that, people, talk to us about our names in our portfolio, and they're often surprised that we don't say, oh, this is a slam dunk. There's no such thing as a slam dunk. There's always something that can go wrong. Things that you don't expect, things that you can expect, and maybe didn't properly handicap. So we try and do our best in triangulating to get to an attractive risk reward, and by considering a range of outcomes that could impact in that business, understanding what the key performance indicators are for that business or industry, and operating in such a way that knowing that we may not be right. And we can be right and yet still not make money. In other words, it was within our range of expected outcomes. And maybe we didn't make money on something, but we had such potential to really make a lot of things work out in this way, but we weren't going to lose that much if it worked out in that way. And that asymmetry made it, an attractive proposition for us. So understanding your own psychology and taking a step back and having that introspection and having that humility and knowing that things aren't black and white, I think is helpful. There's a lot of good investors out there. There's a lot more bad investors, I think, than there are good. But there's plenty of good company out there, people that we've learned from over the years.
Yeah, I try to, at least I try and feel as though I'm buying, I'm investing in quality managers similar to how you would view buying a security. Like you're doing it over a long period of time, and more importantly, you have to invest in quality people. Which kind of brings me to talk about your team. You've been really, really, really good over the years of talking about your team and how important quality management is, and especially making investment decisions.
You're right. I mean, we want to own a good quality business, but if you have a good quality business when you bought it and it's a bad quality manager, that's managing it, they could let competition win around them, and their business can be worth less in the future. I mean, a perfect example was, we mentioned earlier, not to have so many different examples, and it's nice that it always go back to the same. It's like Sears. I mean, Sears was the Amazon of its day. It had so many different, it was the everything store, just in catalog form. I have on my desk over here a catalog from, I don't know, 1908 or something. I mean, they sold everything in that thing. And it's a reminder, of how businesses, can change, how they have to keep evolving if managements, don't, do a good job, and are not thoughtful. And particularly if they're professional managers, and don't have that alignment of interest with you, where they don't have their own money at stake. So that's something we really, really look for. So when you think about allocating capital well and focusing on what's important, having that alignment of interest is paramount. And the managers of the products here at First Pacific Advisors have that alignment of interest. Our capital is invested alongside our investors in various products of the firm, and we're very mindful of that. And the team is a good team. I'm very fortunate to be surrounded by really, really smart people. And my partners, Mark Landecker and Brian Selmo, are exceptional. And they allow, we push back on each other, and we don't always agree, but we find a way to, as concentric circles, there's tremendous overlap. And the people who work with us, our colleagues on the analyst team, some of them have been with us for many, many years, and they've grown up with us, and they think similarly, and we each have different strengths. And we really try and make sure that we work with good, kind, and capable people. All three of those are variables are important characteristics.
Well, thank you, Stephen. That's great feedback, and exactly why we're using you and FPA. And I thank you again for your time today, and congratulate you on the tremendous success over the years.
Thank you, Corey. Thanks for taking the time and interest to reach out and have the call.
Thanks.